In this video, you will learn secrets, portfolio diversification, rule number 3. Diversification trading strategy can help you achieve more consistent returns over time and reduce your overall investment risks. Forex money management and risk control for traders minimize loss and maximize profit by rule number 1, planning your risks, rule number 2, using stop loss, which I talked about in my previous video. And if you haven't watched that, try to do so. In this video, I'll be talking about portfolio diversification. Hi, welcome back. And if you are new here, welcome to Green Forex Academy, helping traders become more profitable. If you haven't yet subscribed, then click here to subscribe. Press the bell icon to receive notification each time I upload a new video. Portfolio diversification, rule number 3, how to reduce your overall investment risks. Whether you are investing in bullish or bearish market, maintaining a diversified portfolio is very important to any investment strategy. A diversification trading strategy can help you achieve more consistent returns over time and reduce your overall investment risks. Now, there are positive and negative correlation in the market. So when trading multiple currency pairs at the same time, you should consider trading with the knowledge of currency pair correlation to avoid winning in one trade and losing in another trade at the same time. If you want to be a profitable trader, you need to divide your capital into 2 or 3, depends on how much you have at hand. Here in this example, you can see that it's divided into 2, 20%, 80%. Now 20% is allocated to day trading cash flow for short-term goals, while 80% is allocated to swing trading / investing cash flow for medium / long-term goals. There is a saying that never put all your eggs in one basket, because you never know what the market can do at any time. Diversify and allocate your currency pairs, investment funds split across multiple asset classes to help balance risks and potential reward. Like I said, here we have 20% allocated to day trading cash flow for short-term goals. And then here we have 80% allocated to swing trading / investing cash flow for medium / long-term goals. So what do you do here? For example, you have 20% allocated to day trading. You want to be trading major currency pairs with 20% of your capital. And you want to be trading swing 80% of your capital, swing trading / investing cash flow for medium / long-term goals, which you're allocating and trading minor currency pairs. Because here on the swing trading / investing, the minor currency pairs, they have more spreads, and because you're looking for 50, 100 or more take profit, you can comfortably trade minor currency pairs with 80% of your capital. You can as well trade even major currencies with 80% of your capital. But if you need cash flow for day-to-day cash flow, then you want to trade major currency pairs with 20% of your capital. Now it all depends on you. You can do this 70%, 30%. But here in this example, I'm using 20% and 80%. That way, it will help you reduce your overall risk while trading if you know how to divide your capital into 2 or even 3 places, depends on how much money you have at hand. Here is an example of a positive currency correlation. Here we have Euro USD 240 minutes, that's 4-hour time frame, and we have GBP USD 240 minutes, 4-hour time frame. Now, if we look carefully, we can see here that the Euro USD is moving to the upside, right? It's going to the upside, and we can see that GBP USD at the end of the day, it's moving to the upside. So why is it positive correlated? It is because Euro USD and GBP USD are moving in the same direction. So positive correlated currency are currencies that move in the same direction, while negative currency correlation are currencies that move in an opposite direction. Now here we have an example of a negative currency correlation. Here we have Euro USD, and then here we have USD CHF. Now we can see, we can pick any point from here. Let's pick this point here. From this point here, we can see that Euro USD was dropping down, was falling, and then from this point we can see that USD CHF was rising to the upside. So from this point we can see Euro USD pushing to the upside, while from the same point USD CHF pushing downward, like going down. So we can see that these are always moving in opposite direction. Euro USD and USD CHF move in opposite direction, and that is why it is called negative correlation, negative currency correlation. So as a trader, for you to be successful trading multiple currency pairs, you need to understand the positive correlation and negative correlation in trading. How to trade multiple currency pairs. Now, let's say that you have this chart in front of you as a trader, and you saw this trend moving, going up and down, and at this point, you just decided to sell the market because you thought the price will keep falling, and then you enter the market at this point by placing your stop loss, take profit, and you have something like this. You're selling from this point, you place your stop loss here, and then you take profit here. But what happened at the end of the day? The market pushed to the upside. So at this point, you lost this trade, and you said, oh wow. And at the same time, when you entered that trade, there's a USD CHF that was pushing to the upside, and you decided to jump in. So you jump into 2 trades, and what happened? You see the price of the market at this point went down, and from this point a trader will be hoping the price will push to the upside so that he can take profit at this point and then put a stop loss here, but the price went down and hit the stop loss. So a trader who enters 2 trades at the same time, Euro USD, from this point thinking the market is going to drop down, and then at the same time he jumped into another trade thinking the market is going to go up, but to his surprise the Euro USD was a loss, and then the USD CHF was a loss. Now you can see from these 2 trades he has double his risks. Why? Because a trader who jumped into 2 trades without understanding correlation might easily double his risks, and at the same time, if he is planning to lose 1% or less than 1%, at the end of the day he might be losing 2% in a day. and that's not going to help him. And this is the reason why so many traders cannot survive in trading, because they jump into so many trades at the same time, trading multiple currency pairs without understanding what is currency correlation. In this video, I'm talking about portfolio diversification, but if you don't understand what is currency correlation, it's going to be very difficult for you to trade multiple currency pairs. Those who trade currency pairs, multiple currency pairs, are traders who understand currency correlation, because each time they want to jump into multiple currency pairs, they already understand the law of positive and negative correlation in the market. Coming back to this point, you can see that negative currency correlation. This is the clear picture of the Euro USD and the USD CHF here. We can see at this point, this is where a trader will say, yeah, let me sell here because the price will keep falling and I'll take some profit here. But what happened? The price pushed to the upside. It was a loss. And what happened here? A trader might think, if I jump in here, the price will push to the upside. Before hitting this point, I'll take my profit. But what happened? The price pushed to the downside and it was a loss. Now, why was this two trades, Euro USD, USD CHF, was a loss? Now, imagine if a trader wants to lose 1% on the Euro USD and he end up entering multiple trades, you will see at the end of the day, he will losing 2%. Which he did not plan for. And this is the reason why a lot of people get frustrated. They feel that trading is not for them. They feel they cannot survive in trading because they have a lot to learn. Now, mind you, trading is a journey. Okay, so if you are facing challenges, you can make it, because most of the professional traders out there, they start out like that, learning and learning and learning. So keep learning and keep moving forward, because winners never quit and quitters never win. So if you want to be successful in trading, if you want to be a profitable trader, keep moving forward. And as you keep learning, you will see yourself taking your trading to the next level. So here you can see that it is very, very important for a trader to understand what is positive and negative correlation in trading. Because if you don't really understand positive and negative correlation in trading, then I would recommend each time you want to trade, you should avoid trading multiple currency pairs. Just trade one currency pair at a time, and that's going to help you to avoid problem of adding to your risks. That is the way to go in trading. And now one of the big problems that traders are facing is going with the crowd. The market crowd and you. This is one of the biggest problem traders are facing, because beginners in trading always follow the market crowd. And I said, do not follow the crowd. Only follow the market price action. Most traders do not follow their trading plan because they left the crowd to influence their feelings, thought, and actions. And that way, they lose money in trading because the crowd always enters the market late. You need to base your trading on a carefully prepared plan. A trader can be successful if he or she is patient and not following the crowd. Remember, your goal as a trader is to trade well and make money from the market. So follow your rules with discipline. That way you will see yourself making money from the market. You will see yourself survive in trading, and you will see yourself taking your trading to the next level. Please leave a comment if you have a contribution or question. Do not forget to like and subscribe for more videos. Please pay it forward by sharing this video with others.